Welcome to the Anchor Your Retirement podcast. I'm your host, Barbara Gullen, in the studio per normal with my buddy and pal, Tony Shore. How you doing, Tony?
I am great. I'm excited to be here as always. I've had a pretty good week. We were talking before the show, just scrambling. Work's been a little crazy.
It has been. It has been. And I was on the road this week.
Yeah.
And, before we jump into today's topic, let's do a little housekeeping. You
Okay.
Okay, you can like and follow us on all of your favorite streaming platforms. And also, if you want to watch the video and see what the two studios look like and what we look like behind the green curtain, you can always come follow us on one of our YouTube channels. And the first YouTube channel is BG Wealth Management, at BG Wealth Management on YouTube. Or for you federal employees, we do have some other videos and timely federal topics on at Fed Retirement. I think it's Federal Retirement Coach. I should have looked at that before we started. Oh my gosh. I had a brain block there. There's so much going on with us relocating the offices and the delay now in relocating our
What do
office.
you think the website is?
I think it's at Federal Retirement Coach on YouTube.
Oh, Federal Retirement Coach YouTube. Let's try it. Yep, it's at Federal Retirement Coach.
The memory was working. But, that's when you like and subscribe, you're going to get notifications when we put new videos up.
Yep.
And it's just a good way to stay in touch. It's a good way to ask questions. Today we're going to delve into it can be a boring topic. It's a tedious topic, but it's a topic that you need to understand since the Secure Act that was passed at the end of 2019 changed how you get to take distributions from an IRA that you inherit. It added a whole different set of rules. And even within the new rules, there are subsets of rules that just keep it that much more complicated.
Right. Well, and I think that this is so important. You've been dealing with this. You've dealt with this over the years with many clients. I know you're going through it right now with a client specifically.
We have, and the pandemic delayed the IRS passing down a bunch of these rules and finalizing those regulations, but they actually were enacted last year. And so I don't want people to operate under the old rules and end up having to pay a 25% penalty. The IRS now calls that an excise tax because they didn't take a distribution that they knew they needed to take.
Yeah.
So we're going to trickle down through we're going to go through some different situations and criteria and tell you how you have to take those distributions. The first one and the easiest one is if you are the spouse of the person who passed away and you inherit their IRAs.
Yeah.
First of all, we're very sorry for your loss, but you actually can retitle these IRAs in your name and you can take the required minimum distributions based on your age.
Yeah. Okay. So that's a unique twist, and I know all these things hit. So explain that to me. Go over that again really quick.
Okay. If you are the spouse of somebody who passes away, and I'm so sorry, I stepped on your line and I cut you off there.
No.
It's a little too much coffee today. You get to retitle that IRA in your name. And you get to take distributions on it based on your age. So if you are not taking required minimum distributions yet,
you don't have to until you're 73. Right.
You don't have to. Yeah. Or 75, depending on the year you were born.
Sure.
So that's the easiest way. And it used to be that when you inherited an IRA, you got to take those distributions based on your life expectancy across the board, whether you were a spouse or not. Now that rule only applies if you are the spouse.
Yeah. And so That's interesting. That's just for the spouse. What if you're inheriting it from a parent? So
If you're
what about
inheriting
the
it from
kids?
a parent, there's two different sets of rules.
Okay.
Both require you to liquidate those accounts within 10 years, and they are traditional or Roth IRAs. Either way, you're going to have to liquidate those accounts within 10 years. If your parent who passed away was not taking required minimum distributions yet, meaning they were young, then there is not a table that defines how you need to take those distributions. You just have to liquidate that entire account by the 10th anniversary of when your parent or friend or grandparent passed away.
Yeah.
If, however, let's say you're inheriting from a grandparent, or let's say you're inheriting from a parent who was already old enough to take those required minimum distributions, you need to take a required minimum distribution every year. You don't get to wait until year 10. And I very seldom advise somebody to wait until year 10, because then, especially if it's a traditional IRA, we have a big tax issue that we've got to deal with. But if the person who passed away was already taking required minimum distributions, you also need to take required minimum distributions based on the IRS's Table 1 for required minimum distributions. There is an RMD factor for your age. So depending on the year depending on how old you are when you inherit the IRA,
Sure,
that RMD factor is a divisor. They look at what the balance of the account was the year before on December 31st, and they divide that account balance by that RMD factor, and that determines how much you have to take out as a required minimum distribution.
no matter how old you are.
No matter how old you are. And you have
Interesting.
to liquidate the account by the end of that 10th year.
Yeah.
If you don't, it's a 25% tax.
So you can't stretch it out like you used to be able to do.
No, you
that went
can't.
away a number of years ago, but the stretch IRAs were great.
Yeah, the only way you can stretch the IRA is if the person inheriting the IRA is a minor at the time they inherited it.
Sure.
Or if that person was determined to be permanently disabled before they reached the age of either 18 or 21, then those stretch provisions still are in effect.
Yeah. Okay. Why does it have to be this? Barb, I'm a little upset with you right now. Why is this so complicated?
I wish I had an answer for that.
Why are there so many rules? You would think there'd be a way they could simplify it. Right?
One would think that, but the important thing to realize is that if you have to take a required minimum distribution and you don't take it, you are going to pay a 25% penalty, or as the IRS calls it, an excise tax based on the amount that you should have paid.
Now, plus you'll have to pay the tax.
Plus the income taxes. The income taxes if it's a traditional. If it's a Roth, there are no income taxes, but that 25% excise tax or penalty would still apply. Now, 25, it sounds steep, but it used to be 50%. So we should be happy, right?
It doesn't make sense, though, that it's with the Roth. I don't quite understand that, because I get the traditional, the government's been giving you a tax break on that. You got a tax break. Whoever got a tax break on the money when the money went in, that money's never been taxed. They want their taxes, so they make you take it out. I get that. A Roth, they're not getting any taxes, but you still have to take it out of that Roth within a certain time.
My hot take, Tony, and this is my opinion, is that, the government is spending $1.5 trillion more than they're taking in annual revenues on average.
Yes. Yeah.
So if they're forcing you to take that money out from that tax-free Roth category, if you're turning around and reinvesting it, you are now paying capital gains taxes.
Yes. That's true. They might
Okay.
they figure they can benefit on that money from some other way.
They will
Or
find
you're
another
gonna
way to
spend
tax
it
it.
and
Or
pay
you're gonna
sales tax
spend
and
it,
pay
and then you're paying sales taxes and
you're
other
paying other
taxes.
taxes. Yeah.
Right.
Yeah. Sure.
So, the name of the game is generating revenue. And when we
Yeah.
tell you that absolutely nothing in life is free, there's more of a grain of truth in that than we want to think about.
Yeah.
But the important thing to understand is that there is a lot that needs to be figured out. And unfortunately, when you are in the midst of grieving the loss of a parent, a grandparent, a spouse, or some other loved one, or somebody who was significant enough in your life that they felt like you deserved to be the beneficiary on this account, that is not the time to have to start making these big decisions.
Right. No, it is not.
And inaction will end up costing you money, because if you don't take the money out when you were supposed to, then the government is going to get that excise tax. If you don't retitle the account into the IRA, into your name. And, here's the thing. If one parent dies and they leave it to 3 different kids, 3 different beneficiary IRAs need to be formed, one in the name of each child.
So, wow, this is a lot to keep track of. What I think, everything you're saying so far leads me to believe I want you to take care of this for me. This is why we work with a trusted financial professional who knows
Right.
these things. Yeah.
This is why we don't go it alone. And especially when you are in the midst of that grief, we all have a tendency to make choices and decisions while we are in that grieving process that we look back a few months later and go, what was I thinking?
Yeah. Right.
So, it helps to have a plan ahead of time. Nobody likes talking about death, unless you're a mortician, maybe. But the fact of the matter is the population has a 100% mortality rate right now. We don't know when, we don't know how, but we do know, yes, it will happen.
Well, I'm not aging, but yeah, everyone else, yes.
Okay, we'll go with that, Tony. Because when I was on the road last week, I met with one person who needed help because they were in the middle of this. And then I met with another set of clients, and we were having the proactive conversations because the husband's dad is getting up there in years and has health issues, and talking about how, there was already a trust in place. So they had gotten that done. Excellent decision. If you are over the age of 50, it's probably time to consider putting a trust in place.
Yeah.
If you are under the age of 50, you at least need an advanced healthcare directive, a durable power of attorney for healthcare, and a durable power of attorney for financial decisions in the event that you're incapacitated. Yeah. And if you have kids, you need to have designated guardians if they are minors in the event that something catastrophic happens to you. But with this other client, we were making those proactive decisions and saying, okay, my child is also going to inherit a portion of the estate. First of all, I think we need to wipe out their student loan debt. Absolutely. Then we need to look at how we can invest the rest. And, and also agreed that we also need to leave some money to spend and celebrate grandpa and acknowledge that this was a gift and do something fun with it.
Yeah.
Working with a fiduciary advisor, somebody like me or me, I'm willing to work with you.
Yeah.
Gives you the opportunity to lay the road work down, have the map, know what we're going to do, so that when we are in the midst of that initial grief, when we have to do stuff because the IRS says we have to get stuff done within a certain period of time, we can at least lay the groundwork and start the process so that we're compliant And then when the dust settles, we can start making decisions about what makes the most sense for investment choices. Where should that money go? Should we pay this house off? Should we pay that off? How do we approach this so that we are wise with the inheritance that we receive? And so that we don't sit back 6 months later and go, how did I go through all of that money? What did I do? And how did I get here? So, most people don't realize that being an advisor is also being a part-time psychologist as well.
Yeah. Well, yeah, you're a marriage counselor, a financial counselor, a therapist. Yeah.
Mhm.
And you've got to handle those roles. I mean, because it all plays a part. I mean, it is an emotional thing. And it's tough. I know, Barb, it's hard when you lose clients or family members of clients. I don't know if I could do what you do because, you're talking about all this planning and legacy and estate planning, and inherited IRAs are a big deal, and
They
the
are.
tax implications and the penalty implications are so crucial.
If they're not handled properly, yes. And, your loved one did not provide a legacy for you, most likely to just randomly go fund the government some extra
Right.
money because in the midst of your pain and your grief, there was a lapse in judgment or a decision that was made or a lack of action that resulted in an extra cost to you.
Yeah. 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 And this is where people make expensive mistakes, isn't it?
It is.
Yeah.
And sometimes they're more expensive than others. But when it's an unnecessary financial cost, it breaks my heart.
Yeah. 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 I think that's, it's, yeah, I've seen it happen with my family members. And I
Mhm,
know you were just telling me before the show about a client you're working with.
mhm.
And you gave a good example of this. And sometimes it's like they weren't getting great advice, so it might not be the best situation. Oh, this is an account that doesn't transfer well, or we have
Yes.
to watch out. There are fees, and
Mhm.
what's it invested in? I mean, there are so many different aspects, Barb. I know that's why you do offer a no charge, no obligation consultation if our listeners and viewers out there have questions, right?
We do. It is a privilege to be trusted by somebody in the midst of their grief or in the midst of a life change and to help them navigate through those waters. And you can do that by calling our office at area code 913-553-6222. Select option 4 for appointments and scheduling. And Christina or a member of our team will get you on the calendar so that we can meet with you. Or if you would rather do this online, you can go to our website, bgwealthmanagement.com. In the top corner, there is a button that says schedule a consultation, and that will take you to a form where we can get you on the calendar and help you sort out what's going on or help you be proactive and start planning out what needs to happen when the inevitable happens.
Yeah, there you go. And nobody likes to think about this, and this is an area people don't plan ahead for because they don't like to have the conversations with their parents or grandparents,
No,
or parents don't like to have this conversation. Nobody likes to think about a parent or a spouse passing, but you
no.
need to have a plan in place and know what's going to happen and how it needs to happen.
Yes, and I mean, I had 3 conversations this week with clients or prospective clients that had lost that second parent and that were now trying to figure out what to do with the inheritance and how to get the inheritances transferred into their names and
Mm,
all of the logistics.
yeah,
So,
it's tough. It's hard.
and it is, but we do that heavy lifting for people on a frequent basis. when we're looking at an application to open up an inherited IRA, it's not the first time we're looking at it. It probably or very well may be yours. So it makes sense to work with somebody who's already been down this road who can keep you from making a crucial mistake.
Yeah. Yeah. There you go. And you've been through this many times.
Yes.
Most of us are only going to go through this process once in our lives, but you do it every day. So that's where you come in. Again, let our listeners know how they can get a hold of you.
Go to our website, bgwealthmanagement.com, or call our offices and do it the old-fashioned way. You can call 913-553-6222.
All right. Well, great show. And you need to understand all the rules, distribution rules, withdrawal rules for inherited IRAs if you inherit this type of an account, and really any type of inherited account. There are issues, whether it's an insurance policy, whether it's an IRA, you got to know what's going on.
If it's a brokerage account, we need to look at stepped up basis and all other kinds of things.
Yeah. Yeah, there you go. All right. Well, Barb, that does it for today's episode. It was a good one, and
Thanks.
anchor your retirement. Listeners and viewers, thanks for tuning in.
We'll see you soon.